What's going on, guys? It's Mac here from Cryptstar, here with another piece of important crypto news. Now, we all seen that the Bitcoin price has been closely tied to the equities market, and yesterday Apple did close below 150, which would have normally crashed the market pretty hard. However, because the Bank of England decided to go ahead and start printing money again, the equities market took that as a bullish signal, and they pumped the markets. Now, I don't think this is a long-term pump. I think that in the end, people are going to realize that by Bank of England erasing rates, they're going to have to raise rates even more later, which is going to be even more negative for the economy in the long run, which is going to lower the stock market even further and put the people of England especially in a more dire situation. Now, let's go ahead and hear what the Federal Chair Jerome Powell says about the PCE and why it is a better indicator for the economic situation and inflation than the CPI.
Ask about right now there's a sort of growing gap between the Fed's preferred measure of inflation, the PCE index, and the one that's followed by the public, the CPI, of course. How do you expect to handle this divergence if the PCE starts to come down enough for you to consider slowing rate hikes, even if the public is still seeing much higher CPI ratings? Thank you.
So it's an interesting situation. Of course, we've long used PCE because we think it's just better at capturing the inflation that people actually face in their lives. And I think that view is pretty widely understood. That said, the public really reads about CPI. And the difference really is because the CPI has higher weights on things like food, gasoline, motor vehicles, and housing than the PCE index does, and so that accounts for a lot of the difference. However, over time, they tend to come together. We were given the importance in the public eye of CPI. We are calling it out and noticing it and everything like that. But remember, we do target PCE. That is because we think it's a better measure. They will come together eventually. The typical gap was really about 25 basis points for a very long time, and if it got to 40 basis points, that would be very noticeable. Now it's much larger than that because of the things I mentioned. So we'll be watching both, but again, the one that we think is the best measure always has been PCE, at least since I think we some 20 plus years ago moved to PCE.
So you guys can see that the PCE is definitely much more important than the CPI. Well, Jerome Powell thinks of them on the same level, but the PCE is a better indicator. And you can see here on Friday, the September 30th, that the PCE numbers will be released. And actually, if you dig a little bit deeper and do a little research on Google, you can see that there's quite a few forecasts that are saying that the PCE will come out really hot, about 125 this quarter, and then it's going to jump by three points next quarter in quarter 4 2022, which means that this gives Jerome Powell a much bigger a lot more ammunition to raise the interest rates even higher than 75 basis points next announcement during their next FOMC meeting. So you can see here that actually went down in July a little bit, tiny bit, from 123 to 121. And the prediction back then was actually 123.12, and it doesn't say their prediction, but yeah, you can see that it's probably going to jump up to 125 this coming quarter. If it's higher than 125, it's going to be really, really bad, and I'm sure the markets will react very negatively. And I think there was a little bit of overreaction to this Bank of England announcement because, like I mentioned before in previous episodes, when you have a bank that stops raising interest rates and starts quantitative easing, then that means that it's going to make inflation run much more rampant, especially for the people in England, and it's going to be much harder for the Federal Reserve over there to go ahead and fight inflation, which means they're going to have to raise their interest rates next meeting even higher, or they're going to just keep inflating their own currency, and then it'll be deflation. It'll basically go down in value against the dollar, and the people are going to suffer like crazy. So they're going to have to change what they're doing. This recent release is actually very bullish for the dollar, and the dollar actually went down, which was interesting to me. But I think the market will sort of more understand this as time goes on in the next couple days. I think we just had such a large sort of crash that people thought that there must be some sort of bear market rally. So yeah, you guys stay aware that this meeting is happening on Friday. Sorry, this data is being released on Friday, and make sure you guys don't get caught with your pants down. I'll see you guys all in the next episode. Have a great day, everybody. Peace out.